Right now, you might have $20,000 in a basic bank account. On one hand, you might think that every month you're losing buying power to inflation and that it's financial negligence to leave cash lying around. On the other hand, that cash is the only defensive wall between you and total financial disaster when life goes sideways. Both arguments are absolutely correct, but both can be equally as dangerous. Welcome to Educating Equity. This isn't a channel for generic financial hype or one-sided investment advice. Today, we're going to present the argument for holding cash versus active market investing. I'd like to present both sides with equal intellectual honesty, and by the end of this video, you will have a framework to find your own educated opinion. Let's begin by establishing the case for safety. Why is it that traditional financial institutions, wealth management professionals, and financial planners place such an emphasis on the preservation of a liquid cash reserve? The answer is the fundamental concept of risk management. For a normal bank account, there is no volatility. When you deposit your money in an insured institution, your principal balance, up to $250,000 in the US or £120,000 in the UK, is protected by law. Typically, cash is the most peaceful place to be for short-term needs like a mortgage payment, surprise car issues, or sudden unemployment, both psychologically and structurally. If you are going to need the capital within, let's say, a 12-month time frame, there is an unnecessary amount of risk in putting that capital into the market. For example, if the market takes a severe downturn the very week you have a large payment due, you are forced to take a permanent loss. Cash removes this vulnerability altogether. But with the security of a traditional banking institution comes an operational point of friction that most consumers do not realize. Many people believe cash is liquid and therefore completely under their control. However, the reality is quite different. Across Western economies, banks are not a standalone industry. For example, under the contemporary anti-money laundering regimes, such as the Bank Secrecy Act in the United States or the Proceeds of Crime Act in the United Kingdom, commercial banks are legally obliged to act as an arm of regulatory and law enforcement agencies. In the US, if you try to withdraw or deposit $10,000 in actual cash, or if transaction patterns reach certain thresholds in the UK, your bank is legally required to file structured compliance forms. Also, if the internal artificial intelligence systems detect rapid movements of capital, which can be as small as $5,000 or £3,000, the institution will submit a suspicious activity report to the authorities. This sets in motion a process that renders the consumer completely blind. The US and UK financial regulations prohibit the bank from telling an account holder that their funds are under scrutiny or why their account is being restricted. It is a federal crime called tipping off. The power balance shifts further when the economy hits a wall. During a crisis, banks protect their own survival before they even think about whether you can get to your savings or not. If you keep a lot of cash in a basic retail account, you're dealing with more than just market fluctuations. The reality is, you take on the risk of the system itself, including frozen accounts or sudden compliance reviews that delay your transfers. Liquidity only matters if you can actually use your money. Leaving all your capital in one bank doesn't get rid of risk. The volatility that you may see in the market is just traded for the risk that the bank might lock the doors or tie up your funds. Now, without emotions and feelings, let us consider purely facts in regards to savings and wealth protection. For many people, an indicator of their success is the figure in their bank account. There is nothing wrong with that. It's extremely comforting when you see a 5-figure sum just sitting there. The numbers do not change unless you want them to. However, it's important to separate the nominal value from the real purchasing power. Think of the current economic state of the world. In America, for example, inflation, which is measured in headline terms on an annual basis, is heading towards 3.8% at the time of recording, mainly due to the systemic prices of energy and food. Meanwhile, the average interest rate paid on a conventional basic account in the economy stands below 0.1%. Similar developments can be witnessed in the UK, where, as of now, inflation is rising towards 3.3%. However, ordinary banks operating in high street locations provide an interest rate that can barely beat that. Here is the math for a basic savings account holding 20,000 units worth of funds. Taking into consideration that inflation is at an average of about 3.5% over 5 years, the actual amount in the principal is still 20,000 on the computer. However, its actual worth is reduced to only about 16,500. You have not lost in figures, but in 3,500 worth of actual food, energy, and real estate. By keeping capital locked in a low-interest account, especially if it is long-term or structural capital, then you could argue that you're not necessarily avoiding risks. Rather, you are paying the direct cost of inflation. This is how the School of Investment thinks about the fact that cash is a liability. After witnessing such structural decay, the reaction from the modern world would surely be to simply deposit all those extra dollars and pounds straight into the market, right? But this brings us directly to the counter-argument. This is where the hyper-aggressive investment camp exposes themselves to a catastrophic blind spot. They overlook the forced liquidation trap. Picture this: you've chucked all of your savings into the market, but then real life occurs. A medical emergency, a corporate downsizing, or a severe macroeconomic contraction hits. Now, could you imagine if a massive personal disruption occurs at the exact same time the broader market downturns? If you hold no liquid cash buffer to cover your immediate, real-world living expenses, you're forced to access your investments and sell them at a massive discount. This action completely destroys the point of long-term compounding. You have converted a temporary paper loss into a permanent realized capital loss. Furthermore, depending on your tax jurisdiction, this forced liquidation can trigger unexpected capital gains liabilities or early retirement withdrawal penalties. Cash is the best insurance policy. You do not judge the value of your home insurance policy based on whether it generated a 10% return this year. You judge its value by its capacity to protect you from total devastation. Cash functions identically. It buys you the time required to keep your long-term investments untouched, allowing them to ride through any market downturns safely. So, where is the line? How do you separate the silent liability of cash from the mandatory safety of liquidity? At Educating Equity, we reject arbitrary rules of thumb. You do not need an influencer to tell you to blindly save 6 months of expenses, but you do need a framework based on your personal optionality threshold. To build your blueprint, you must divide your capital into 3 distinct tiers. Tier 1 is your friction buffer. This belongs in your basic checking or current account. It should never exceed 1 to 2 months of essential operating costs. Its purpose is purely transactional liquidity, and you accept that it will earn 0 return in exchange for immediate friction-free utility. Tier 2 is your core insurance reserve. This constitutes 3 to 6 months of true fixed living expenses. This capital must be completely detached from your primary retail bank to protect against outside risk. Instead, store it across easy access, high-yield vehicles, such as a modern high-yield savings account backed by FDIC insurance in the US, or a flexible cash ISA or premium savings fund protected under the FSCS framework in the UK. This capital remains safe from market drops, accessible within 24 hours, and insulated against maximum inflation erosion. Tier 3 is your production capital. Every single unit of currency beyond your Tier 1 and Tier 2 thresholds is no longer allowed to sleep in cash. It must be actively reallocated into productive wealth streams. If you are risk-averse, you could utilize short-term government debt instruments like US Treasury bills or UK gilts via Treasury Direct or institutional brokerages to capture the macro interest rate spread safely. If your horizon is greater than 5 years, systematically allocate that capital into broad market index funds tracking structural asset growth. So stop looking at your capital as a singular pool of money. Instead, think about dividing your capital. If you want to build your personal wealth blueprint using verified financial data, hit the subscribe button. This is Educating Equity, and we will see you in the next video.